I think a problem that the Fed is facing is that they're not as in control as they're used to being, which is to say that over the past 40 plus years, up until the last few years, the country operated in monetary dominance, which is to say that most money creation was from bank lending, and the Fed's tools are mostly geared toward either encouraging more bank lending or slowing down bank lending. We're in an environment where fiscal deficits now exceed bank lending in most years. It used to be that would only happen briefly during recessions when bank lending would slow down and fiscal deficits would increase. But now we see it throughout a full cycle that just fiscal deficits are running hotter than the net new amount of bank loan creation. And fluctuating your interest rates doesn't really encourage the sovereign entity to spend less or more. It's not really correlated in that sense. And so they can slow down bank lending to offset fiscal driven inflation, but that's not necessarily an outcome that they want either. That just means that the US government becomes the largest share of the economy because you're slowing down private sector access to capital while the US keeps pouring a fire hose of money into the system. I think generally speaking, interest rates are kind of less impactful than most analysts have come to believe over the past 40 years. It's not to say they don't matter, but it's just a smaller component than if we were having this conversation 20 years ago. In general, the market has seen a little bit stickier inflation, a little bit stickier economic performance to the upside in a good way. And so that kind of says, well, maybe the Fed doesn't have to keep cutting. But basically, when we talk about 50 basis points in either direction, I think that's less impactful than the market thinks. And the bigger question is what's going to happen with the fiscal situation. That's a bigger component, in my view, toward the economy and asset price performance than 50 basis points from the Fed. Same thing with tariffs. If we wake up tomorrow and there's 20% tariffs across the board on all imports, that's more than 100 basis points difference in either direction than the Fed. So I think that most of the big questions are more centered around fiscal, and the Fed is more of that marginal actor at this point. I think another relevant question to look at is the Fed going to stop quantitative tightening this year? I think they most likely will by the end of the calendar year. I can see some scenarios where they push into early 2026, but my base case would be by the end of 2025. They've ended quantitative tightening, not because inflation is necessarily back to its target, but because they'll run into the liquidity floor of the US banking system and therefore have to go back to structural balance sheet increases in a similar way they had to do at the end of 2019. So I think we'll probably see that. And that could open up some interesting narrative. If you still have inflation above 2% and the Federal Reserve is gradually increasing their balance sheet, what kind of narrative does that send? So I think there's a lot of moving parts more than just interest rates. Any policies that encourage reshoring are welcomed. I think that the hard part is it's hard to address without going after the roots. I think a lot of policies tackle the surface, which is, okay, so we have structural trade deficits, let's do tariffs. Tariffs kind of address the end result, but it doesn't really get to the root, which is to say that, if you don't want to have as big of a trade deficit, there are a few politicians that would say, let's re-examine the structure of the dollar system itself. In fact, the likely incoming Treasury Secretary has restated that they want the dollar to remain the global reserve currency. Now, they could potentially shift the definition of what that means exactly, but they do like the power to sanction countries around the world. I think the problem is that some of those goals conflict with each other. So then it depends on how they're weighted. In general, I think there's a lot more variance in this administration than most other administrations, which is to say, I can't really tell you 6 months from now what tariff policy looks like because I can imagine very different outcomes. And so it's more of a scenario you have to react to what happens rather than forecast what's going to happen. But in general, I think anything that focuses more on the economy and less on maintaining kind of dollar hegemony is probably a good policy. And I think that they have some conflicting things. I think the policies that err more toward that industrial side are probably more beneficial. It's saying, okay, so other NATO countries should pay their agreed upon percentage of defense. The U.S. doesn't have to be involved in every foreign conflict that happens. That doesn't mean that we can never be involved. There might be ones that we consider quite important to be involved for various historical reasons or because the scale is too important or because the specifics of that are relevant. And then to say, if you have two competing things, which is one, we want to be able to sanction any country, or two, we want to reshore our manufacturing base, which one's more important? And then the overlay there is, okay, so the U.S. government also benefits from being able to run deficits, which benefits from the global reserve currency status. So then the question is, if you want to give up some of that privilege to reshore some of that, that also generally means the government has to be a little bit more fiscally responsible, which of course it's very hard structurally to do right now. Either way, any sort of change is disruptive, and disruptions can be painful, especially for winners of the prior era. But even for upcoming winners of the next era, disruptions are still often unpleasant when they go through it. generally transitions like this, there's more ways to fail than succeed, or there's more ways to have a less than optimal outcome than the narrow path of having the optimal outcome. I do think we're probably entering an era of more protectionism, probably higher average inflation, and more variance where you can do all the analysis you want on a given company or a given asset, and then some sovereign decision could just append that or change the outcome of that investment. And so politics gets entwined with finance a little bit more thoroughly, and I think that's the era that we're in now. I'm generally not a fan of tariffs, but it depends on context. If you replace a domestic tax with an import tariff, that could make sense. In general, if we get to a world of more portable capital and we get to a world of better privacy tools, one of the challenges that the entire structure of income taxes being a predominant source of government revenue in the world is based on ubiquitous surveillance. It's based on that presumption. It's basically not an accident that income taxes became very prominent at the same time as banking became very prominent, which is to say that, in the 1800s, a lot of people would still exchange like coins for goods and services, and bank accounts was kind of a more niche thing among merchants and wealthier people. And as we entered an environment where we're in the post-telegraph age, so the whole world's kind of increasingly connected by telecommunication systems starting in the late 1800s and really extending into the 1900s, most people have bank accounts. Those bank accounts are centralized around central banks. That whole system's surveillable, and so they tax people's income, and that's kind of where the taxation shifted. If we enter a world where capital's more portable, there's more privacy, income taxes become less, they're more unwieldy to do, and taxing more tangible things can make sense. So focusing more on property or physical business establishments or borders and things like that. And that's where tariff policy could be relevant. But in general, things that disrupt global trade, especially at scale, are something I would advise a lot of caution around, because a lot of the disinflation we've seen over the past 3 decades or so is a result of globalization. So when Chinese capital and Russian energy unlocked the world in the 1980s and 1990s and met Western capital, that was a productivity boom. That was basically saying, okay, there's all these untapped resources of labor and natural resources, and here's capital, and let's build a lot of new stuff that really kind of benefits the world. And we're losers from that. I think most people on average were winners, but the losers were if you were manufacturing in the US or certain other countries. And it's natural that they say, well, we don't love that approach. So I generally favor anything that is good for productivity, which would mean basically pretty free-flowing trade. But there's a real politic aspect behind it, which is when a country is very imbalanced, we should expect pushback. And I think that's the era that we're in now. So I wouldn't be surprised to see tariffs. And if tariffs replace certain other taxes, I would support that. In practice, what we probably see is tariffs layered on to other taxes. And so I do think we have more frictions ahead, unfortunately. If the dollar debasement rate slows down, then sure, that can slow down Bitcoin price gains for a period of time. I generally have pretty low prospects for Doge's ability to meaningfully and sustainably cut the US deficit. I've published some articles either myself or in collaboration with Sam Callahan, kind of analyzing the different aspects of that, which is to say that a lot of that focuses on the people that work for the government or the waste that's there. And I do think it's a really good idea to, one, focus on the deficit, bring transparency to the deficit. I think especially the DoD has a lot of fat that can be cut out and reprioritized. And so that's potentially hundreds of billions of dollars per year in savings. But in general, most of the deficit is things that are not actually super tied to efficiency. So they're tied to Social Security being very top heavy now. They're tied to Medicare and Medicaid. The 2024 GOP official platform, Promise 14, says not to cut Social Security or Medicare or raise the retirement age, which is different than the Paul Ryan era of the Republican Party. That's hard. That's who votes also. Then there's interest expense, which is obviously challenging to cut. And then there's some basic services, and then there's DoD. So there's certainly things you can cut and get optimal, like optical wins to say, okay, look, we saved this $1 billion program on, this one random type of fish preservation in a place no one heard of, right? There's lots of little optical wins you can get like that are going to make really good tweets. But then the question is, when we look back after 4 years, is the deficit going to be meaningfully lower than it is now? I don't think so. And in addition, there's going to be pushback on a lot of those little niche programs. And then also, one thing I've highlighted is that the US is more financialized than most other countries, which is to say, if you take a country like Canada or Germany and their stock market has a good or a bad year, it doesn't hugely impact tax revenues. The US, our tax revenues are heavily correlated with stock market returns with a little bit of a lag because the stock market is so big and there's so many global players in our stock market, and our tax structure is more geared. One, we have more wealth concentration, and also we're just more geared to stock market performance. And so any sort of austerity that actually ends up hurting asset prices, you get this weird scenario where then tax receipts suffer and you don't cut as much of the deficit as you thought because you trim spending, but also your income dwindles a little bit. And so it's a really challenging Gordian knot to undo. And then the Medicare side, the whole kind of broader healthcare side, the US spends by far the most per capita on healthcare without better outcomes for most people. That's a very entrenched system. I think it's really worth tackling, but I think it takes more than the span of one administration to do that. I think it's tied to diet, it's tied to how we prioritize agricultural subsidies. It's cultural. Then it's the way our healthcare system itself is structured with the insurance and the pharmaceuticals and all that. There's multiple layers of intertwined power that it would take to really unravel to actually meaningfully lower healthcare spending in the country. And I think all of that's a noble goal. But again, I think 4 years from now, we look back at the deficit and my bet would be that it's still quite big. I think it's a good goal. I think it's possible to add 3 million barrels of production. I don't think right now the limiter on U.S. production is actually government. It's certainly the case that some administrations can be more favorable toward drilling than others. But the funny thing about the prior administration is their words were often against drilling, but then because they wanted to curtail inflation, they actually really weren't in practice that much against drilling except around the margins. And a lot of times what we're seeing is that the industry themselves is slowing down their own production, because what we saw in the 2010s was companies would drill unprofitably, try to maximize every barrel they could get. They would get outside capital from investors to do it. And after the whole thing kind of blew up, they had very little to show for it. And so now we see that the industry is more cautious. It doesn't have as many external dollars supporting it. And so they're drilling out of their own profits. They say, okay, we're making a profit. We could pay dividends. We could buy back shares. We could improve our balance sheet, or we can reinvest more of it into more drilling. They actually have to weigh that and say, okay, well, what is the oil price? What do we expect the oil price to be? What is the supply demand characteristic? And then they make some decision on how much they want to reinvest in the capex. And I think that the industry itself is more rightly conservative with that now. And I think that's actually been the main limiter for why, U.S. oil production has kind of touched around all-time highs, but hasn't kept surging. In addition, there's also physical realities of well depletion, which is to say that shale oil depletes quicker than other types. You get a well operating faster, but then it depletes faster. And they've already got a lot of the low-hanging fruit there. So wells that they do now generally have faster depletion rates than wells from 5 or 10 years ago. That's a physical reality that just makes it marginally harder to get every sustainably higher oil production barrel. But I think it's a good goal to basically maximize energy independence and, support energy production. As far as the others, again, that goes back to my comments on Doge. I think it's a good goal to say we want to get deficits down to 3%, but that's harder to do in practice. When you have top-heavy Social Security systems, you no longer have structurally falling interest rates to offset your interest expense. And so I would take the over on the numbers they end up there.